Hey, what's up, Brad? Just wondering how you use gamma when you're selling options in the wheel strategy. I've noticed that as I get closer to expiration date, the gamma is increasing, but I don't know what you would consider a high gamma or a low gamma, and just what your how you use gamma in your short puts and short calls.
Awesome question. If this makes it to a clip, I'm gonna leave the video for my Greeks. The video on the Greeks, probably my third most viewed video. Options Greeks. So first and foremost, I'll say like when I'm doing the wheel and stuff, I don't really care that much about any of the Greeks. Delta I'll look at to kind of see my probability. So what is gamma actually going to do for us? If here's how I think of it. And guys, I'm not going to give textbook definitions of these Greeks because when I read textbooks, I don't know what they mean. I'm going to give you practical applications. So we have gamma and delta play together. So delta, the technical I'm not going to tell you the technical definitions, but let me tell you the technical definition is essentially how much the value of the option is going to increase or decrease with a $1 increase or decrease with the share price. So for example, if you have a delta of 0.9, right, and the share price goes up $1, the value of that option will go up 90 cents, which is why we use it in a practical sense as a kind of a representation of how many shares we own, right? Because if you had a delta of 1, which you don't, like 99 would be, I guess, the highest you can really go. If you had a delta of 1 and the share price went up $1, how much did you just make? You made $100. The same as if you owned the shares and it went up $1. So that's kind of how we use it. That's the one like practical thing we think about delta. The other thing that we kind of rule or thumb or generalize with delta is the probability that that option is going to be in the money at expiration. So favorable to the buyer. So at the money, deltas are generally about 0.5, right? Because you got about 50-50 chance that's going to go in the money or out of the money when you're at the money. The deeper and the further you go away from the share price, the less likely the buyer is to succeed, which is why in leaps, right? When we sell a leaps, we go down as the buyer of the option and we sell at 0.9. That gives us a 90% chance, roughly, that that option is going to expire in the money. Right. And when we write calls and we write things against poor man cover calls, we go with a delta of, say, 0.2, because that means that the buyer has a 20% chance. So that gives us an 80% chance of success. So to understand delta, that's kind of what you have to understand. We're thinking the probability that is going to end in the money at expiration. Now, so how the hell does gamma play into that BS? Gamma is like the stability factor. So gamma is given as a percentage, and it tells you how much that delta is going to change with the $1 share price. Okay. So these Greeks are always ebbing and flowing. They're always up and down. They're not static. They're not fixed. So as we go closer to the money, away from the money, all of these Greeks, they start to change. So when I'm at the money, Vega is going to be, not Vega. When I'm at the money, gamma is going to be pretty high. As I go further away, gamma is going to be really, really low. It's more stable. When you buy a leaps, that 0.9 is going to stay there. It doesn't fluctuate. It doesn't jump all over the place. So you ask, like, what's a high gamma? Just like a lot of the Greeks that we can look at, it's all kind of, you have to compare them. It's all relative. So for example, if I looked at two options, and both of them had a delta of 0.2, right? But one had a higher gamma. There's more risk with the higher gamma, right? There's more because that swing, that probability that it's going to expire in the money changes quicker with the $1 share price. So when we have a high gamma, here's how you can look at it. If the share price were to go in an unfavorable direction, right, the value of your option is going to go away quicker. It's good. It's more volatile. Okay. Now the volatility side over there with Vega and Vega exposure, I guess you can kind of look at both of them. But to answer your question and not babble on, you really have to think of it as a stability factor. If delta is the probability that it's going to be in the money at expiration, Gamma is the stability of that probability over time. So the lower the delta, the lower the gamma, the more likely that delta is going to stay pretty fixed. It's not as risky. The higher that gamma goes as you approach the share price and the strike price, as you approach the money, that gamma is going to increase, and that's going to make delta swing a lot more with the same exact $1 movement as compared to another stock with the same exact delta and a smaller gamma. If you're trading the wheel, you could not even think about gamma, if I'm being honest. Trading the wheel, most of them don't matter. If you're going to trade the wheel, you understand theta, but we're so close to expiration where theta is not really going to do that much, right? If you're doing the wheel and you're doing weeklies, like theta's already done most of its job. It's going to trickle down and get rid of extrinsic value for a little bit. So if you're doing the wheel, you kind of get theta. You don't care about vega necessarily. And like I said, I don't think you should really necessarily even care about gamma. And you can look at delta as just your probability if you're writing calls and puts. You kind of decide, like, I'm new to this. I kind of want to try a couple. Then you're going to write at a delta of like 0.2. Give yourself an 80% chance it's going to expire out of the money, right? Because with a delta of 0.2, that means the buyer has roughly a 20% chance it's going to expire in the money, right? So you're the opposite as the writer of that option. Same thing with the cash secure put. You kind of have the collateral. You don't necessarily want to get assigned. You're going to write a small delta because a small delta is a small probability of success for the buyer. You are the seller when you're writing cash secure puts and calls. So you want a higher percentage opposite of the probability going in your favor. Thanks a lot for the gamma question.